Hi students, in the last class we saw the problems on the profit prior to incorporation. I hope all of you understand that problem. Okay, so now see the problem number 2. X company limited was incorporated on 1st August 2013 to take over the running business of X and Y as a going concern as from 1st April 2013. Okay, the following statement of profit and loss has been prepared for the year ending 31st 3 2014 of the company. Okay, so these are the profits as well as the expenses given. Okay, so these are the expenses, just see. So these expenses we have to distribute under the time ratio as well as the sales ratio. Okay, so now see what will be the time ratio, how it's the time ratio, you know that. Okay, in the last problem we solved. Okay, so this X company, okay, so this X company is incorporated on 1st August. Okay, so what, first of all, try to understand what's the financial year. Financial year is what? 1st April 2013 to 31st 2014. Okay, so at the mid of the year, it means what, the on 1st August 2013 got the incorporate this X company. Okay, so this X company take over the business of X and Y. Okay, and the X company got the incorporated on 1st July 2000, 1st August 2014. Okay, it means what's April to August. Okay, April to August, it is nothing but the prior period. Okay, prior period. After the August to March, it is the post incorporation period. Okay, so now see, so further information as well as given, just see, rent was paid at rupees 1000 per month up to 1st August 2018, and thereafter it was increased to rupees 2000 per month. Okay, so related this rent and rates 23,000 is given, no. Okay, so related this adjustment is there. Okay, we will see, we will prepare the working note. Okay, so next, the average monthly sales for the first 4 months during the year rupees 60,000, whereas the average monthly sales for the subsequent period were rupees 70,000. Okay, so whatever the prior period will come, for the prior period will be the 4 months. For this 4 month, each month is rupees 60,000, and further 8 months for this 70 per month. Okay, the sales. Okay, so now we will try to understand the solution. Just here, solution, the financial year 1st April 2013 to 31st March 2014. Okay, so the incorporation date is on 1st August 2013. Okay, 1st August 2013. Okay, so now this what will be the prior period up to 1st April 2013 to 31st July 2013. Okay, 31st July 2013 will be the 4 months. Okay, it will be the prior period. Okay, and it is incorporated. Okay, so this August to August to March, it will be the 8 months. It is nothing but the post period. Okay, so the prior period is 4 months and post period is 8 months. Okay, what will be the time ratio? So you know the time ratio, prior period is to post period, and the prior period is 4 months, post period is 8 months. Okay, 4:8. Okay, or 1:2. How it's a 1:2? Take it the common factor for this 4:8. Okay, common factor will be the 4. So 4 1s are 4, 4 2s are 8. Okay, so this shortcut ratio is what? 1:2. Okay, so next, what's the sales ratio? Prior sales is to post sales. Okay, so now see, the prior sales is what given. So now see, in this statement is what's given, the prior sale for the 4 months per month 60,000. Okay, so each month 60,000, just calculate 60,000 into 4, it will be the 2,40,000. Okay, and for the remaining 70,000 for the 8 months. Okay, so 70,000 into 8, it will be the 5,60,000. Okay, so now see, this 2,40,000 is to 5,60,000. Okay, so now cancel it, all these 4 zeros, cancel it, all these 4 zeros. Okay, remaining will be the 24:56. Okay, 24:56. Okay, so now see here, take a common factor for this. Okay, the common factor will be the 8. Okay, 8 3s are 24, 8 3s are 24, 8 7s are 56. Okay, so this is like this. We have to calculate the ratios. Okay, if it is not getting the common factors, then as it is we have to take 24 is to 56. Okay, for the other figures. Okay, for this figure the common factor is what, 8 is there. Okay, so now like this you have to calculate the sales ratio and the time ratio. Okay, so now we will solve the problem. Just here, statement of profit and loss for the year ending 31st 2014. Okay, so now see here, the sales is given in the problem. The sales means revenue from operation is 8 lakh. Okay, so just see here, sales is 8 lakh is given. Okay, and it is the in the problem the for the pre-incorporation period is 2,40,000 is given. Okay, and the post sales is 5,60,000 is given. Okay, so because here they mentioned no. Okay, for the 4 months 60,000 per month. Okay, 70,000 for 8 months. Okay, so like this we calculate 2,40,000 for the pre-incorporation and post-incorporation 5,60,000. Okay, so the total revenue was for the pre-incorporation is 2,40,000 and for the post-incorporation 5,60,000. Okay, so now this we have whatever the expenses are there, so these expenses we have to distribute under the time ratio and the sales ratio. Okay, so as it is all the expenses with these figures means rates or the amounts or as it is I taken in the problem. Okay, just see here, directly we will solve here only. Okay, cost of sales. Okay, like this we have to draw the format, you saw in the last problem. Okay, so cost of sales is 6 lakh. So this 6 lakh we have to distribute under the sales ratio, which is 3:7. Okay, 3:7. Okay, so this how to calculate this for the pre-incorporation, 6 lakh into 3 divided by 10, it will be the 1,80,000. Okay, and for the post incorporation 4,20,000. Okay, so next salaries and allowances rupees 60,000. So this 60,000 we have to distribute under this time ratio. Okay, and time ratio is what, 1:2. Okay, so 60,000 into 1 divided by 3, it will be the 20,000. Okay, and post incorporation is the 40,000. Okay, next rent and rates. Okay, rent and rates. So just see, for this purpose working note is there. So this working note, how it is working note, just see, rent was paid at rupees 1,000 per month up to 1st August 2013, and thereafter it was increased to rupees 2,000 per month. Okay, so now see how it means what. Okay, up to prior period rupees 1,000 per month, and before after incorporation is 2,000 per month. Okay, and what's the total rent and rates? It's 23,000. Okay, so now see here how it's so to allocation of rent and rates. The total rent and rates in the problem is given 23,000. Okay, and if it is calculate rent prior to incorporation 1,000 per month for the prior period, and prior period is a 4 month. Okay, 4 into 1,000 is 4,000, and after period is what, after incorporation is the 8 months are there, and each month is rupees 2,000. Okay, 2,000 into 8, it's a 16,000. Okay, so now see, so 4,000 as it is we have to record. Okay, so see here rent and rates. Okay, rent and rates. Okay, 4,000 for the prior incorporation and 16,000 for this post incorporation. Okay, like this we have to pass. But just see, so from this 23,000 we have to minus this 20,000. Okay, from this 23,000 we have to minus this 20,000. The remaining balance will be the 3,000. Okay, so 3,000 again we have to distribute under this time ratio 1:2. Okay, one will be the 1,000 will come for this prior incorporation, and out of this 3,000, 2,000 will come for the after incorporation. It means what, 4,000 plus 1,000 out of this 3,000, it will be the 5,000. Okay, so 16,000 plus 2,000 out of this 3,000, it will be the 18,000. Okay, like this we have to solve the rent and rates. Okay, so next one is a general expenses 7,200 under the time ratio. Okay, so 7,200 into 1 divided by 3, it will be the 2,400 for the pre-incorporation and for the 4,800 for the post-incorporation. Okay, so director's fees, it is the specific expenses, so directly we have to transfer in the after incorporation. Okay, so next selling expenses, this 4,000 we have to under this sales ratio 3:7. So 1,200 for the pre-incorporation and 2,800 for the post-incorporation. Okay, so next discount on sales. Discount on sales is 1,000 under the sales ratio, 300 for the pre-incorporation, 700 for the post-incorporation. Next advertisement. So advertisement, it is 3000, it is the sales ratio amount, to 900 amount for the pre-incorporation and the 2100 for the post-incorporation. Okay, the formation expenses mean the preliminary expenses 1800, it is the direct expenses means what, it is the specific expenses. So this specific expenses we have to direct affect on the post-incorporation 1800. Miscellaneous expenses 1200, it is the time ratio. Okay, 500 for the pre-incorporation and 1000 for the post-incorporation. Interest on debenture 1400, it is the post-incorporation, it is the specific expenses directly affect on the post-incorporation. Next, when interest to vendor up to 30 September 2013. Okay, 2013, 6000. Okay, so just see here, this financial start from 1st April 2013 and its end with 31st March 2014. Okay, so now see, from 1st April, okay, from 1st April to September there are 6 months. Okay, and the amount is what, 6000. It means of each month is rupees 1000. Okay, and for the prior period, how many months are there? 4 months. Okay, 4 months into 1000, it will be the 4000 for the prior incorporation, and remaining 2 months means up to July, September is August and September, for the 2 months is the nothing but the prior period, post period. So this 2 into 1000, it will be the 2000. Okay, so it means March to September, April to September there are 6 months, and each month is rupees 1000. So 6 into 1000, it will be the 6000. Okay, so out of this 6000, 4 months are the prior period. So that's why 4 into 1000, it will be the 4000, and the remaining 2 months for the post incorporation. So this 2 into 1000, it will be the 2000. Okay, so repairs and buildings is 1200, it is the time ratio, it's 400 for the pre and 800 for the post. Okay, next, depreciation also 2400 under the time ratio. Okay, the 800 for the pre-incorporation, 1600 the post-incorporation. Okay, so now see the total expenses. Okay, so total expenses for the pre-incorporation is 2,17,000 and for the post-incorporation 5,03,000. Okay, so now we have to ascertain the capital profit or the net profit. Okay, so now the pre-incorporation period, what's the total revenue? It's 2,40,000 and post-incorporation 5,60,000. Okay, so now this 2 lakh, from this 2,40,000 we have to minus all these expenses. Okay, all these expenses, and what's the total expenses? 2,14,000. Okay, so this 2,40,000 minus 2,17,000, balance will be the 23,000. So this 23,000 is nothing but the capital profit. Okay, whatever the profit is getting prior incorporation is nothing but the capital profit, and after incorporation whatever the profit is getting is the net profit or the revenue profit. Okay, so this 5,60,000 minus all these expenses, all the expenses means 5,03,000. Okay, 5,60,000 minus 5,03,000, it's 57,000 is the profit, is nothing but the net profit. Okay, so now see, so this 2,17,000 plus 2,17,000 plus 23,000, total will be the 2,40,000. 5,03,000 plus 57,000, it's 5,60,000. Okay, so like this we have to solve the problems, and I hope you understand all the note also, allocation of rent and rates. Okay, so as well as just try to understand the interest on vendors. Okay, April to September there are 6 months. Out of the 6 months means July, up to July it's a prior period, and June, August, September there are the post period. Okay, so like this we have to calculate. Okay, I hope you will be understand the problem. Okay, if it is not understand, you can contact me. Okay, so thank you.